Greetings to everyone. My name is Edward, and you can call me Ed. Here is pros and cons accountancy tutorials. And as we may be aware, we started our session on IAS 36 impairment during our last video, and we promised to continue with impairments on a cash generating unit. Now, in our last edition, we made mention that impairment is where your carrying amount is higher than your recoverable amount. And we mentioned that the carrying amount is the amount at which you are keeping your assets in your books. And the recoverable amount is the amount that you can gain from using the assets. So in two ways, we said the recoverable amount is either or is the higher of your net realizable value or your value in use. We were able to deal with some questions to show how the value in use is supposed to be calculated. If you are not given it and you need to calculate for what the future values to add up, because value in use, as we said, are future values that you are going to get from using the asset to the end of its useful life. However, the net realizable value is the amount you are going to gain from what selling the asset today. So surely it is the fair value less cost to sell. Now, with this, we said if you have an impairment or if the carrying amount is higher than the recoverable amount, then simply there is what? Impairment. If you have impairment on a cash generating unit, a cash generating unit can be a particular asset, or it can be a group of what asset, it can be a department that generate what? That generate cash or it generates revenue and then cost by itself. So if that cash generating unit, the asset within that cash generating unit has been impaired, then we will need to attribute or recognize the total impairment on the number of on the assets within the cash generating unit. So the question we ask ourselves is, on which asset are we going to recognize this impairment first? On which assets are we going to recognize this impairment first? I think that is where we actually got to when we wanted to talk about the cash generating unit. But in our last edition, I think the focus was on just to know the general thing on what? Impairment. So today, we want to focus on a cash generating unit. Now, as I said earlier, we want to know the first asset that we should recognize the impairment on. And under impairment, which is IAS 36, talking about the cash generating unit, the first asset for which we need to recognize the impairment on is a damaged asset, an asset which is deemed to be what? Damaged. You may have an asset, then we will say part of the asset is what? Damaged. So the asset is 15,000 or 20,000, but 10,000 of it is what? Damaged. A part which costs 10,000 is damaged. So the impairment first has to be what? Associated to that asset or the 10,000 part of the asset. So if your impairment is about, let's say, 20,000, then 10,000 has to be associated to the damaged part of the asset, which is 10,000. Then the rest of the 10,000, we can go on to recognize with other assets. So let's see how we are supposed to recognize it, the asset on which we are supposed to recognize this impairment. 1. IAS 36 is saying that we will have to recognize the impairment on a damaged asset. It may not be that the asset is damaged, but it is stolen as well. So it is damaged or stolen asset. Damaged or stolen what? Asset. Then 2, we recognize it on intangible assets. 3. What we will have to do is whatever asset is left, we will now prorate two other assets. So in a given scenario, if let's say we have impairment of 40,000, impairment of 40,000, and then we have number of assets. So PP, we have, let's say, let me just say vehicle. So we have a vehicle, we have a plant, we have inventory. So let's say vehicle is 40,000 or 30,000, right? So that we don't get confused with the impairment amounts. This is 15,000, and then this is 10,000. The impairment is 40,000, right? The question is, where are we going to allocate this to? We are not, within this, there's nothing like an asset has been stolen or an asset has been what? An asset has been damaged or a certain asset is damaged. So what we have to do is to prorate the impairment to all these what? Assets. What we have to do is to what? Is to prorate. How do we then do the prorate? It means that part of the impairment has to go to vehicle, part has to go to plant, part has to go to what? Inventory. So in prorating, we will need the total of this, the total of the assets. 30 plus 15 plus 10 will give us 55,000. So in terms of prorating, to vehicle will be what? 30,000 divided by 55,000 times 40,000. That is the impairment amount. And then that of plants will be 15,000 divided by 55,000 times 40,000. And then to inventory, 10,000 divided by 55,000 times 40,000. So whatever we get will be recognized on the assets. So basically, that is the prorate aspect of it. But if we had intangible in this scenario, then we would have first recognized the impairment to the intangible. In actual fact, if we had a damaged or stolen asset, then that would be the first where we recognize what the impairment. Then for going forward, we recognize it on the intangible assets. So let's have a scenario so that we can use it to deal with this, right? On the intangible, intangible, we have a lot of things under intangible. So under intangible, you may have brand, you may have all other things, but you may have what we call goodwill. Goodwill. So if within the intangible you have goodwill, then if you are allocating or recognizing on the intangible, first recognize to what? The goodwill. So let's say you have recognized the impairment on a damaged item or a stolen item, and still you have some of what? The impairment left. You are supposed to recognize it secondly to where? To intangible asset. But if within the intangible asset, you have goodwill, then you first have to allocate it to what? The goodwill. You first have to recognize it to the goodwill. Let's have a scenario and then solve and see how best we can deal with impairment on a cash generating sheet. All right. So in that case, let's have this scenario. Let's have this scenario. So if you look at this illustration, Belwa Limited acquired a taxi business on 1st January 2005 for 230,000. The value of the assets of the business at that date, based on net selling price, was as follows. So we have vehicle of 120,000. We have intangible asset of 30,000. We have trade receivables of 10,000. And then we have cash of 50,000, as well as a trade payable of 20,000. So net is 190. Net is 190. So imagine your net is 190, but you purchase the asset at what? 230. What does that mean? It simply means that you've purchased something that your eye cannot see, a certain intangible, and that's what we call goodwill. So anytime you purchase something more than its net price, it becomes what? The change or the difference becomes a goodwill. The difference is what we call a goodwill. So let's take this question and try and see how we will be able to analyze it on our board. So if you look at the question, it means we are going to get what? Intangible. We are going to get a goodwill. We are going to get a vehicle. We are also going to get other intangible. And also we are going to get inventory. And aside inventory, there's also what we call payables also there. So it is the payable which has been taken out to give you the net of what we are seeing to be what? 190. So I'll say that without much ado, we can go to our board and then analyze the question and solve it out to see how best the understanding will be. I always say that if you have any challenge, please kindly put it on our comment section so that we will be able to reach out to you and sort issues out. So let's go to our board. Now, looking at this question, we will have to put up the assets first. So that we have assets. We have the assets. Sorry, we have the assets. And we have the cost of the assets. We have assets and we have the cost of the assets. First, we have our vehicle. We have our vehicle, and the vehicle has a price of how much? The cost of how much? The vehicle has a cost of 120. And then we have intangible assets with a cost of 30. We also have trade receivables with a cost of 10. We have cash with a cost of 50. And then we are having our trade payable with a cost of liability of 20, giving us the total to be 190. But the consideration is what? 230. So in that case, we will have a goodwill of 40. A goodwill of 40. And the question made mention that they want to allocate an impairment of how much? An impairment of 45. Let's look at the question again. They want to allocate an impairment of what? 45. So the impairment is 45,000. They want to recognize impairment of 45,000. But within the vehicles, 30,000 has been stolen. 30,000 has been stolen. So this 45,000 first has to be recognized on the vehicle so that we can take the 30,000 what? Off. So let's go back to our question. So if we should go to our next page, if we go to our next page, we will have assets. This time around, we want to include the goodwill. The cost, the assets, the vehicle is 120. The intangible is 30. So somebody may also decide that let me add the goodwill to the intangible. It's also cool. We can add the goodwill to the intangible so that whatever we are charging, we are allocating to goodwill, we just allocate to intangible. But at the end of the day, it is to what? Damage or stolen, and then to intangible. So we can add the goodwill also to the intangible. Then we can allocate it there. But we can also decide that, look, let's separate the goodwill and allocate or recognize the goodwill first, so that if anything is left, we can recognize to us the other intangible. So intangible, we have 30. Then goodwill, we know that goodwill we have 40. Then we have trade receivable of 10. Then cash of 50. And then payable. So trade payable of what? 20. Now the impairment that we can also recognize. First, the vehicle, some has been stolen, 30 has been stolen. So we have to take 30. Then we will be left with what? 15. You know that the impairment is 45,000. So if we allocate 30, it will be left with 15. And we are saying that we have to allocate it to what? Intangible. But first to goodwill. First to what? Goodwill. So we allocate the rest of 15 to goodwill. The rest of the 15 to what? Goodwill. So what will be our carrying amount? So the recoverable amount, our recoverable amount will now be 90 plus 30 plus 25 plus 10 plus 50 plus and then we less our 20. So this is how our recoverable amount is going to be. So 90 plus 20, plus 30 plus 25 plus 10 plus 50 minus less 20 will give us 185. 185. So this becomes our recoverable amount. This becomes our recoverable amount instead of the 230. So basically, this is the idea of impairment, recognizing impairment on a cash generating unit. The question is, what if the impairment which was given to us was, let's say, 100,000? If the impairment was 100,000, if the impairment was 100,000, first we have already recognized 30, and we have also recognized 15. So in that case, we won't recognize 15 to goodwill. We recognize the overall 40 to what? We recognize 40 to what? Goodwill. And we will be left with how much? 30, 40 is giving us what? 70. So we'll be left with 30,000 impairment. And that 30,000 impairment would have been recognized to what? Intangible, the other intangible asset. The other intangible asset. And in that case, we will not have any recoverable amount for both the other intangible assets and the goodwill. And the goodwill. So that would have ended our impairment here. And at the end of the day, our recoverable amount in total would have been reduced, right? It would have been reduced to be 90 plus 10 plus 50 less what? The 20 to give us 130. To give us 130. So this would have been our recoverable amount. As I said, if let's say it was 200,000, if it was 200,000, remember, first here is gone, right? 100,000 is gone. So the additional 100,000 would have been prorate. It would have been prorate on the rest of what? The asset. The asset left. The additional 100,000 would have been prorate, like the way we did in the illustration here to that what rate. All right, so this is where we will end our session talking about IAS 36 impairment on a cash generating unit. I must say we appreciate all your comments and also your subscription and then the like that you give to our videos. I will urge you and also beg you to subscribe to our page if you've not. If you see it to be interesting to just like and share to friends and family so that we can all come together as one. And if you have any issue, please kindly put it at the comment section. We will be glad to hear from you and get to you so that we can sort issues out as times go on. Thank you very much. And this is where I call it close. Bye-bye.